Now let's talk about bank reconciliation. And the intention of the bank reconciliation is to explain the difference between the values in the bank statement, or the ending balance in the bank statement, and the cash balance in the ledger. So that's the main purpose of having the bank reconciliation. So we'll see how it works. So again, as it says here, bank reconciliation is an analysis of the items and amounts creating the difference between the cash balance reported in the bank statement and the balance of the cash account in the ledger. The adjusted cash balance determined in the bank reconciliation is reported on the balance sheet. So I want you to remember one thing. When we are making these kind of adjustments, nothing is correct on the bank statement and nothing is correct on our ledger, because there's some information that we know that the bank didn't know about, and there's information that the bank knows about it, but we don't know about it. So when we update the ledger, we're only updating our side. Time would make the bank statement adjusted on the bank side. The only thing is, if there's an error on the bank side, we just need to let them know about it. So bank reconciliation is usually divided into two sections, and these two sections are the bank section and the company section. So the bank section is the one that presents the bank statement. So it begins with a cash balance according to the bank statement and ends with the adjusted balance. The company section begins with the cash balance according to the company records coming from the ledger and ends with the adjusted balance. The adjusted balance from the bank section and the adjusted balance from the company section, they need to be equal. So they must be equal. If they're not equal, then there's something that we're missing. So this is the format of the bank reconciliation. You see here that on the top we have the cash balance according to the bank, and it's coming from the bank statement, and this is the ending balance coming from the bank statement. At the bottom we have the cash balance according to the company, and this is coming from the cash ledger. So we look at the general ledger cash balance, and that would be the value that we should start with. And then we start updating the bank balance based on the information that we know but the bank didn't know about. So what are these kind of things? We have two major things, something called deposits in transit, which are deposits not recorded by the bank yet. So we have, like, let's say we received some checks, and these checks were not deposited in the bank yet. We didn't bring them to the bank yet. So the bank doesn't know about it. So these need to be added to our balance according to the bank. So we add the deposits not recorded by the bank, and we call them deposit in transit. And then we deduct something called outstanding checks. And outstanding checks, these are the checks that we signed and we gave them to maybe our vendors, and the vendors didn't cash them yet. So the bank doesn't know about it, but in our records it shows that this is a cash payment. So we have to deduct that from the outstanding, or deduct the outstanding checks from our bank balance, or the balance according to the bank. So remember, we add deposit in transit, deduct or subtract the outstanding checks, and then the difference, or the balance, is going to be added to the cash balance according to the bank, and that way we get the adjusted balance. On our company side, so we have the cash balance according to the company, which we bring it from the ledger. We need to update it with information that the bank knew but we didn't know about. So what are these kind of things? So we need to add credit memos that have been recorded. In other words, notes collected by the banks. These are notes that were collected by the bank on our behalf. We didn't know about it because the bank collected it, and the only way we know about it is whenever we receive the bank statement. So now we need to add it to our cash balance according to our ledger. The other things that can be deducted from our cash balance according to our ledger is debit memos that have not been recorded, something like non-sufficient fund checks or NSF checks, or service charges that are charged by the bank. Again, this kind of information we only know when we receive the bank statement from the bank. So once we add the credit memos, deduct the debit memos, we get the total adjustments. It's either added or subtracted, and we bring the new adjusted balance. This adjusted balance for the cash balance according to the company should or must be equal to the cash balance according to the bank, which is the adjusted balance here. So the two adjustments should be the correct ones. And that's the value that we need to update our ledger with. So again, I'm not going to read the steps here, but it's just simple terms. We start in step number 1, and that's on the bank side, the bank section of the reconciliation. We start with the cash balance that we bring from the bank statement. We add the deposits not recorded by the bank, which we call them the deposit in transit. Then we subtract or deduct the outstanding checks, and that will give us the adjusted balance. Then we have step 5, 6, 7, and 8, and these are related to the company section of the reconciliation, where we get the cash balance according to the company, and we bring it from the ledger, from the cash balance in the ledger. We have the credit memos, we subtract or deduct the debit memos, and then we determine the adjusted balance. The verification stage or step is step number 9, where we verify that the adjusted balance determined in step 4 and 8 are equal. So basically we want to make sure that adjusted balance on the bank side and on our ledger side, they match. So let's see this example. Here we have the bank statement shows a balance of $33.59.78 as of July 31st. The cash balance in Power Network ledger on the same date is different. It's $25.49.99. So now we see that there's some kind of discrepancy here. They're not exactly the same. So why we have this difference? So we need to prepare the bank reconciliation, and that should help us determine why we have this difference. So the following reconciliation items were identified, and this is additional information that was given to us. So deposit of July 31st not recorded on bank statement is $816. We call these deposit in transit. So $816.20. We have 3 outstanding checks, check number 812, 878, and 883. And their total value is $1544.99. And then we also noticed that there is note receivable that was collected by the bank on our behalf for $400 plus its interest of $8 collected by bank, and these were not recorded in our journal. So that's a credit memo of $408. Then we also have check from customer Thomas Ivy, $300 returned by the bank because it's of insufficient funds or non-sufficient fund. And this needs a debit memo of $300. There's also a bank charge of $18 not recorded in the journal, and that also another debit memo. So in addition, check number 879 for $732.26 to Taylor Company on account was recorded in the company's journal as $723.26. So this indicates an error. So as you can see here that they flipped the number, which we call it the transposition. We have 732 was by mistake recorded as 723, and we'll see how we can record this. And this is, or correct this. It's an error on our side, not on the bank side, and I'll explain that in a second. So let's see how the bank reconciliation statement would look like. And we start with a bank statement balance, and that was given to us based on the bank value, $3,359.78. Then we make the adjustments, and we have one value to be added, which is the deposit in transit, which is given to us, $816.20. And then we have 3 outstanding checks, and all of these would be deducted or subtracted. And that will give us a total adjustment, $728.79, because the total of these 4 numbers are negative. So we subtract the $728.79 from the $33.59, and we get the new adjusted balance of $2630.99. If the total here is a positive value, then we just simply add it to the cash balance. So we don't always subtract. It just happened that the total of these 4 numbers turned out to be a negative value, and that's why we're subtracting it from here. Then we have the cash balance according to the company, which was Power Networking, and that's the value we brought from the ledger, $2549.99. So we had the note and interest collected by the bank. That's something to be added. We didn't know until we got the bank statement, so we need to add that. We have the check returned because of insufficient fund, or NSF. That has to be subtracted, $300. We have the bank service charges. They have to be subtracted. And then we have this error correction for $9. So why they're subtracting the $9? Let's try to understand that. So as you can see here, it says check number 879 for $732.26 to Taylor Company on account was recorded in the company's journal as $723. So this is a check that we're paying out to one of our vendors. We overpaid or over-recorded the payment or under-recorded the payment. As you can see here, we under-recorded the payment. The correct value was $732. However, we recorded in the books a lower value. So when you under-record a payment, this shows that you have a higher balance. Because I was supposed to, or actually I paid more, but on my records I showed that I paid less. So my balance would be my mistake showing a higher balance. So I need to reduce this balance by the difference. And the difference between the 732 and the 723 is $9. And that's why we're subtracting $9, because we want to bring down our cash balance to the correct value. Because we're showing that we made a smaller payment. And if we make a smaller payment, then the cash balance would be overstated. So we need to bring it down by $9. And that's why on the bank reconciliation here, you see the error in recording check number 879, we have a minus $9. So we add these four numbers and it turned out to be a positive value, $81. So we add the 81 to the $25.49.99 and we got $26.30.99. We make sure that it matches what we have in step number 4, and we are correct. So we've done everything correct. Bank reconciliation should always, always, always match. If they don't match, then we made a mistake. So what are the journal entries needed? We need to make journal entries to update our records with the information that we didn't know about. And this is the information that we brought from the bank statement. In our case here, we have like few things that we needed to update. First of all was the note receivable that was collected on our behalf and its interest. And we also need to make sure that we record the non-sufficient fund, the bank service charges, and correct the error. So let's start first with the things that would increase our cash balance, which is the notes collected and the interest revenue. So since they collected the note is going to be credited. It's going to be on the credit side for $400. And then we also have interest revenue for $8. And these two values are going to increase our cash. So our cash is going to be debited for a total of $408. Remember, interest revenue, they like the credit side, so that's why we're recording the revenue on the credit side. Then we have the accounts receivable. Remember, this was supposed to be a check that we collected from Thomas Ivey. Thomas' check didn't go through, so we have to bring the accounts receivable back again. So we have to increase the accounts receivable, and we increase the accounts receivable on the debit side. Then we have the miscellaneous expenses, which is for service charges. It's an expense. It's recorded on the debit side. And then we have to reduce our accounts payable by the $9. And then for the total of these, we are going to decrease our cash balance by $327. So after we make these updates to the cash balance, our cash balance has to be correct, or has to reach the correct value of $2630.99. So after the preceding journal entries are recorded and posted, the cash account will have a debit balance of $2630.99. This cash balance agrees with the adjusted balance shown on the bank reconciliation. So there's a checkup corner here. I'll leave that for you. And in the next video, I'm going to be going over petty cash fund.